Good evening and welcome to tonight's member-only webinar where we look at ASX investment opportunities in review for the 19th of July. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service which incorporates our model portfolios as well as an independent portfolio where we can utilise derivatives to enhance portfolio returns. If you'd like to know more about the service, please contact me on 1300 614 002. The technology using tonight is the Investor Signals member area. If you're joining us for the first time, part of your 30-day free trial, please take the time to give me a call in the office, and happy to spend some time guiding you through the software and setting up the model portfolio alerts for you. At the end of the trial, you can subscribe to the technology for $1,320 for the year. The table on screen we touched on a bit in last week. Obviously, we're moving into the second week of US earnings. This week we had the banks last week, mostly the share price reaction to the bank results, although the headline numbers were good. They were padded as a result of increased trading revenue and from re-provisioning or adding back pre-provision loans. So seems to be a building consensus in the market that there's some risks around US earnings being at levels sort of close to as good as it gets. What that means as an average for 2021, obviously you have to be patient and see that picture play out. But the first sign that that may be coming true, that concern that earnings have peaked, will be this second quarter, the average of the second quarter earnings, and the goal that the market's working towards is obviously seeing US earnings coming closer to, or at least building towards this $200 level from roughly 170 where the market's expecting 2021. I think it's fair to say that those 2021 expectations probably sit a little higher now than that 170. That was some months back, but the 22 earnings is about right. If we look at that as to what it means for the index, and I'll have a look at the S&P 500 in a moment. But this is the Nasdaq. In last week's recording, we looked at the Nasdaq under the interim sell signal, but we gave it the benefit of the doubt with the support under that low, given that the market closed above the moving average. If we actually have a look at what's transpired, and this is on the S&P, and now I'll move back to the Nasdaq in a moment. But the S&P earnings, what I want to look at here is at $175 of earnings. Where were we pre COVID, which the relevance of that is before interest rates fell to these emergency settings. So at $175 of earnings for the S&P, this is roughly the level that it was trading at, around 3,200. $185 of earnings, roughly about 3,700 points. And if we're able to reach this average of 195, and we'll have a better picture for that at the conclusion of this second quarter earnings for the June period, it would support the S&P being on around 4,000 points. So to me, the risk for the markets probably, initially maybe could we see a pullback of 6 to 8%? Well, that's possible. The first sign that could be playing out is obviously this type of pattern here. You can't get a sell-off without sort of a break below this 10-day moving average. You get a lower high pattern, and now the relevance simply becomes putting the resistance level above these and seeing if the market trades back through that. Then clearly we're back into a risk on, and you want to be taking more risk in portfolios. But right at the moment, the theme has to be to reduce the number of holdings slightly, think about some level of protection in portfolios, and look for buying opportunities that are in relatively defensive names. So something like Cleanaway or having some gold exposure. Are some ideas, but the idea of tonight's webinar is obviously we'll explore those a little bit further. The Nasdaq, as I mentioned, just having a look at that before we move into the ASX Top 100 tonight. So the Nasdaq, this is the picture we have here. The stochastics rolled over. The market has the ultimate high there at that 14,800 level. We attempted to kind of continue this buy on the dip pattern that's been in place for the most part of the last few months. Uh, but we actually ended up with a fairly soft close on Friday night in the US, and obviously futures are down at the moment. So the pattern that we watch here in the Nasdaq is again the stochastics rolled over, and the markets sort of made this lower high pattern just within this top pattern here. So for that reason, we remain a little bit cautious, and what that does is set up a couple of the inverse ETFs just to have a think about, which is on the XJO is the bear ETF, and we haven't seen big percentage moves in these, but obviously they're reacting to the indexes moving lower and these ETFs moving higher as a result of that. So if you're looking for hedging instruments for portfolios, the inverse ETFs are a way of doing it. The BBOS is the double inverse ETF. The SNAS, which you may not be familiar with, is the short Nasdaq. So if you want to look at specifically the technology area, certainly the risk coming as we get into earnings season, we see some of the tech companies in the US report later this week. It's ultimately going to be either the stabilizer for the broader index. If we see good results out of Amazon, out of Alphabet, out of Microsoft, it could be enough to see the market consolidate sideways. There are a number of stocks in the S&P 500 now, though, that are well below their highs. So even though those leading tech stocks have helped to keep the index reasonably stable up until now, underneath the surface over the last, say, 2 months, you've seen deterioration in some of the high-value speculative tech stocks. And you've also seen deterioration in some of the banks and financials in the US as well. So, with respect to our market, we'll look at the XJO and then I'll move into the ASX 100 this evening. The XJO, similar pattern here, where the market's below the 10-day average. I've put in the two resistance levels. If we see the market move back up through that moving average, that's the first sign of adding risk back onto portfolios, and ultimately, on the long side of the market, we look for it to trade back through those two levels of resistance. But for the time being, you just need to be a little bit more cautious with the way you're thinking about and looking at the market. The top 100 tonight, click on the watch list, select top 100 from the list. We get the percentage gainers to the top, and let's just move through these in buy order. We'll be looking at the ones that are under buy signal, which are in the model portfolio, and then we'll move through the ones that are under sell, and I'll conclude tonight with a quick summary of the preferred allocations which have been covered on the blog. ResMed continues to perform well, as I've highlighted in previous weeks. They're benefiting from stronger earnings forecasts or upgrades to their earnings as a result of competitor product line being withdrawn from the market. If we look at the performance of the algorithm, it's done very well on ResMed. Domino's, we see their US counterpart report their earnings results, I think, later this week. That might be a number that's just of interest. But Domino's, obviously, more exposure into Europe and Asia and Australia. The business continues to perform strong, and we're happy to be a buyer of that on any future algorithm signal. If we look back at when the last signals occurred, back at $82, and then again earlier in November last year at around 71. The momentum there is favourable. Earnings pattern remains strong, and comfortable being a buyer of Domino's on a dip there. Afterpay, we're not doing anything there at the moment, just highlight that it is in the model doing well. Xero I continue to like as a high quality tech stock, but again, be patient and have a wait. If you don't already own it, wait for a pullback to the next buy signal. Cochlear we like, and I'll update you on the upcoming earnings result via the blog on Cochlear. Wesfarmers is still our highest weighted exposure in our client portfolios, but we did start trimming the size of this position today. So we've taken some profit on Wesfarmers, but it still remains the largest position on a relative basis to any other holding in the portfolio. But that's performed extremely well, Wesfarmers. Metcash is under buy signals. It was a relatively new entry to the ASX 100 following the index rebalancing last month. The stock has switched from sell conditions into buy conditions in October last year, and then we had a subsequent buy signal again here at around this 340 level. But what concerns me a little bit with Metcash is the relatively low levels of earnings growth, probably only 2 to 3%. So I still think you're better off in Woolworths over Metcash. Woolworths I like, so we'll put this in context. They're stripping out the $6 of Endeavour drinks. The stock price is back slightly above the previous high there. The stock's on low 2% dividend yield, so it's expensive, but I do expect the earnings to be strong and possibly surprise a little on the upside. So I think the downside risks here are low, and you could look at adding a call option to enhance the income return there. But Woolworths is a buy in our preferred staple, preferred exposure for consumer staples there. So Woolworths is a buy. Cube Holdings, I think you can certainly have a think about adding this into portfolios. You might only just start with a small exposure to this at the moment, given the volatility in the market, but the correction from 3.25 down to $3, we like that, and it's in our models. Sydney Airports has performed very well, so clients where we manage their broking account for them. Sydney Airports is within the top sort of 3 or 4 weighted exposure holdings in our models, and it's obviously been a big beneficiary of the takeover bid, so we've been well positioned there around Sydney and continue to hold that. Treasury Wines, we have a small exposure to this in portfolios. It's rallied from $10 up to $12, and we continue to hold that. Goodman Group's been our preferred or overweight property stock. We really have been weighted towards Goodman Group and SLF in client portfolios. Switch from sell conditions into buy conditions around the $16 level, now pushing up towards 22. I do think it's getting a little expensive, but it is a high quality company where growth is as guaranteed as it can be. Mirvac Group, in the model portfolio, we don't have a big exposure to this, but it certainly does sit in the portfolio. But again, our overweight position is Goodman Group and SLF as a broad exposure to the property trust. But Mirvac's under buy signals. Tabcorp's a recent switch from sell conditions some time ago into an algorithm buy signal. We've got the upcoming demerger of the business units that I've discussed previously. GPT, we like. The current environment's going to be difficult for anyone with retail or office trust exposure for the market to view favourably for obvious reasons at the moment, so we don't see GPT doing too much in the short term. WiseTech Global under buy conditions. CBA's under buy. We just a little concerned up at $100. The stock price was getting a little expensive, and we've taken profit on that. We've moved to more of an overweight in Macquarie as our preferred financial play. And I just highlight that Westpac is recently switched to buy conditions, and we've just started adding a very small exposure of Westpac, and we've kept that position size small at the moment given that backdrop of concern around how the indices play out in the US. In the case of CBA, if we see this back at around this $90 level, we'll look to add it into portfolios again, which will be about 10% lower than where we sold it. JB Hi-Fi under buy conditions, but we've been a bit cautious on this, worried about sort of slight slowdown in retail spending, and I think we might see the evidence of that in the coming months. Charter Hall under buy signals, but not an overweight position. Stockland's pulling back, and another buy signal at the moment, so it's switched to buy back here in December last year, rallied up towards $5, so rallied almost 20% from that signal. We're seeing a pullback at the moment. I've created that band there from $4 to $4.40, where you could think about taking advantage of this softness in Stocklands. Beach Energy under buy conditions, but not really doing too much there at the moment. Lendlease, as I've discussed, we like that as a long-term recovery play, but recognise that it's a really tough environment for the business right at the moment. Westpac, we've seen this switch back to buy conditions just in the last or today, and possibly on Friday as well, so we can just use the mouse to roll that out a little bit further to look at the exact days. So the signal was Friday and on Thursday. We've seen a little bit of buying off the lows today, and on that basis, we've added a small portion of that into portfolios, but we'll continue to average into it if we see softer markets there. Harvey Norman, not doing there at the moment, is under buy conditions. Challenger, again, not doing there. Our preferred exposure is Macquarie. Star Entertainment under buy conditions, but we do hold Star, but again, not a large weighting for obvious reasons at the moment. Macquarie Group we like, so within sort of that financial space, we think that's the lower risk position for the moment. Incitec Pivot looking for a second half recovery in earnings, and we like that. Link Administration, you've seen both Link and Computershare come up with buy signals today. Link's done the spin-off of PEXA. They hold, I think, around 45% of the independent PEXA listed business. The fundamentals for Link and Computershare remain reasonably sound. We'll have a closer look at these earnings results as they come through. Certainly we add Link onto our watch list and start having a closer look at that now. Aristocrat Leisure under buy conditions, but maybe getting a little expensive. Think about that on the next sell-off. Fortescue we like, but we did start trimming the size of that position today and taking some profit on Fortescue. Downer EDI, we still like this space, although clearly there's disruptions to their daily businesses at the moment. But Downer and Cimic's still our preferred play via call options, and I put a post on the blog today. Soul Pattinson not doing it there, is under buy conditions and has performed well. Aurora Group under buy conditions and performed well. Take a look at Aurora on a pullback and the next buy signal in the coming months. Computershare we like, but give it a little more room on the downside before adding that into your portfolios. BlueScope performed extremely well since switching from sell into buy conditions here at around $16, now pushing 22. Crown Resorts, obviously difficult environment at the moment with a little certainty as to when normal trading conditions may return. So it's a very high risk proposition. The only reason you would be attracted to Crown, I think, is if you felt that the takeover bid from Blackstone or the potential deal with Star could go ahead almost regardless of the disruption to the trading conditions of the business. If you felt that was possible, then the stock has upside back up to maybe as high as $13 odd. So just keep an eye on that. The first catalyst would be the share price trading back above that 10-day moving average to see that there's momentum building back in the stock. Woodside Petroleum, a little bit softer short term, but we still think oil stays reasonably well supported up around $70. Cleanaway, you need to add this one to your watch list. So I don't think buying anything aggressively at the moment makes sense or is required. And for the most part, any of these stocks where I suggest they're looking good or the fundamentals support from a technical standpoint and timing. Do you buy it today? Do you wait to tomorrow as a figure of speech? What we want to be looking at there is really just being patient enough for the price action to get back above that 10-day average, and just to keep an eye on that pattern that's developing in the Nasdaq and the S&P, and as long as they're sitting below that 10-day average, I don't think there's any need to rush into adding a lot of new exposure in the first few days of what could be a potential sell-off in the market. So, but Cleanaway we like, and I think you want to be a buyer of that on the dip and the first sort of transition back above that moving average. IGO's performed very well since being under buy conditions. Centre Group, I've shifted this support down a little bit further. Obviously, retail's going to be tough at the moment. REA Group, high quality business, we really like it, just too expensive, and that's a stock that I think will be susceptible to a correction in the Nasdaq. IDP we like, is expensive and we're not chasing it where it is at the moment. BHP, still one of the best of breed within the resource space. I think if you're looking for resource exposure, you want to continue to hold BHP. You may start to trim the size of the position if you're sitting on good gains there. Likewise with Fortescue, you may want to think about trimming the size of that position. On the buy side right at the moment, Oz Minerals is starting to look attractive, and you could start to build a small position in that. If you want broad ETF exposure, have a think about OZR as a overall resource ETF. But I'm less, at the moment our focus really is BHP, Fortescue, but cutting the position sizes and just starting to build a small position in Oz within the resource space, in Incitec, but obviously less in the metals there. Santos, we're avoiding. It is in the model, but our only overweight or large exposure within the energy space is Woodside Petroleum. It's still our preferred positioning. Seek we don't like, we just think it's a bit expensive, and have a look at that on lower prices. South 32 is in the model, small holding, but not our preferred exposure. Alumina, the volume and production numbers were fine, but the company's costs were above expectation, and we've seen the market deal with that negatively. I'd be surprised though if this sell-off really gathers momentum, but again, the strategy here has to be just to wait, and we'll watch this one when it trades back above that 10-day average. But I think the market at the moment is digesting the higher operating costs there. Oz Minerals, this is what I mentioned earlier, pulled back from 27 down to $20. Copper should still remain well supported over the next 12 to 24 months, but again, you probably don't need to rush into taking a big position in this at the moment. Just wait for it to trade back above that average and keep an eye on how long the Nasdaq and the S&P trade below that 10-day average that I highlighted at the beginning. Altium, high quality tech stock under takeover, although the company has rejected that. Northern Star, still our preferred gold exposure. Just highlighting Evolution there, had some production numbers that came in at the lower end of the range, and Evolution seems to be underperforming now, so I still think maybe being positioned in Northern Star is the better of the gold plays, but Northern Star and Gold Roads remain our preference. Linus, not doing there, performed well since switching to buy conditions though. Oil search preference remains Woodside. Evolution, as I touched on earlier, is under pressure just with those softer production numbers. Both current and their forecast production numbers came in below expectations. Fisher and Paykel, so now we've gone into stocks that are under sell conditions. Now healthcare is an area where during a risk-off period in the market, money's going to rotate towards healthcare names. So you'd expect this sector to do well on a relative basis at the moment. But I do feel Fisher and Paykel's a little expensive, and I'd probably be more of a seller on the rally there. Sonic Healthcare, high quality, but is getting expensive. CSL we quite like, but it is under sell conditions at the moment, and we look to pick that up at lower levels in the weeks or months ahead. Brambles is under sell conditions. I think fair value's up around 11.50, so at the moment I don't think the downside risks are substantial. Ansell is also under sell. APA Group, we're seeing a recovery here, and this is a result of money moving into infrastructure. We've seen Spark Infrastructure under a takeover, Sydney Airport's under a takeover. So the interest globally in infrastructure assets is increasing at the moment, which can be supported for a number of reasons, but as I've spoken about, we're seeing those yields on the 10-year treasuries in America continue to move lower. So the long end of the curve is actually flattening out, which makes these infrastructure assets more attractive in a low-yield environment. ASX, high-quality business here. Even though it is under sell signals, I think the downside risks are limited, but likewise on the upside, there's not too much in the way of earnings growth at the moment for ASX. So I think it bumps sideways, but the fully franked dividend yield is attractive. Coles we like, but Woolworths remains our preference. Spark Infrastructure, as I mentioned, under a takeover bid. Nine Entertainment, we're avoiding that. Ramsay Healthcare is under sell signals, but if we look at the performance of this over the last 12 months or so, roughly supported around $60, resistance up at around $70. it is under an interim buy signal there, so shuffle the support line up a little bit closer, and I'll just shift this down to here just to put this into the picture. So support there at around 62. I'm not sure that we've seen a final conclusion on this takeover bid for the UK hospital group, but with or without that, certainly the story looks better if that acquisition goes ahead. But I think Ramsay could be reasonably well positioned for a fairly defensive income play for portfolios back on support there at around $63. AusNet not doing there at the moment. Boral under takeover bid from 7 Group. Medibank back up against resistance. I think some risk sit there, as with NextDC. Bendigo, regional banks I'd avoid at the moment. Telstra we continue to like, just the attractive dividend yield and fairly moderate levels of earnings growth there. Bank of Queensland under sell signal, avoid the regionals. Dexus not doing there. AGL not doing there at the moment. Car sales back up against resistance and looking for a sell-off in car sales from this $21 level. So I think we get resistance here, a sell-off, and I'd look to buy this on the dip, and I suspect that we see that shift to buy signals in the coming weeks or months. A2 Milk, continue to hold that as a recovery play. Amcor, I think this is a defensive area that you can think about holding a position in and maybe selling covered calls. Again, you probably don't need to be aggressive with adding many positions into your portfolio right at the moment, especially with the S&P below that moving average. But Amcor, coming into the upcoming earnings results, the company's guided towards 10 to 14% earnings growth. So I think Amcor, the risks to the downside are relatively low. James Hardie up against resistance where it is at the moment and susceptible to a rollover and a retracement lower. Ampol under sell signals, resistance at around 30. The major banks, for the most part, are near resistance. Obviously, the exception to that is starting to accumulate small amount of Westpac at the moment. But again, hard to get aggressive on the long side of the market with the indexes below that average. Origin, in the back half of this year, I wouldn't be surprised to see Origin break through that $5 resistance level, and it could be a stock that you think about owning calls in as a way of limiting your downside but capturing that upside potential of the stock price. Suncorp up against resistance, not doing there at the moment. NAB, it's pulled back roughly 10% from its highs. NAB, which is not out of step too much with the US, something like Citigroup or some of the other leading US banking stocks have pulled back the same or slightly more. Mineral Resources looking for that to pull back and switch to buy conditions later this year. QBE not doing there at the moment. Transurban, have a look at Transurban on a little bit more of a pullback in that. Qantas under sell signals now, that's been removed from the model. Orica under sell signals. As we get into the sort of the tail end of these stocks that are under sell conditions, it's just worth drawing your attention to how the algorithm works here. So the sell signal being the red box up the top here, and what you're looking for is stocks that are making lower lows and lower highs, and the reference point there to the algorithm, I put in a resistance line, and as a secondary confirmation you could be looking for the red arrow pointing down, and then finally from a pure momentum standpoint you could be waiting for the stock price to trade below that average. Now that's going to be more if you're looking for shorting opportunities in the market, and that's really just a complete mirror reverse of the methodology on the buy side of the market. AZJ undersell signals. It's maybe been making these cascading lower lows, lower highs, but maybe we're getting to a point where we could see this break out of the long-term downtrend, but resistance there just under $4 for AZJ. Insurance Australia, as I mentioned in previous recordings, it is under sell conditions, and the most recent signal was the alert there on the high at 530. We've seen a correction from there, a little over 10%, but I wouldn't be surprised to see Insurance Australia Group break out of this consolidation range that it's been in since October. So it's mostly moved between 450 and 550 since October, and I'd be looking for this sell-off at the moment, and take note of when the stock price trades back above that moving average, and we may start to see a beginning there of a breakout and return back to that $5.56 price range. Rio undersells signal, and we've lighten the exposure to BHP and Fortescue, as I mentioned earlier, but maintain those as long positions. AMP undersell signals. Reese looking for this to pull back, and we'll take a look at this in the coming months once it shifts back to algorithm buy signals. But on the sell side there at the moment, Wally's making lower lows, lower highs, and back to Endeavour Drink. So just to finish with a couple of the ETFs that we have been discussing. The Asia Tiger Technology ETF. Now, these technology names offer slightly better value than some of the higher priced US technology area, but it's not without its risk. We've obviously got risk on both front from Chinese regulators moving in and regulating these tech stocks, which is predominantly about securing privacy information. The first company that we've seen the Chinese government deal with in that regard has been Alibaba, but we're starting to see similar approaches affect Tencent, Baidu, and the other major technology companies, JD.com. So this Asia technology ETF is unlikely to do well if the Nasdaq struggles. So I think the same argument applies. You want to approach it with a little bit of caution, but the value here in this technology area looks far more appealing than that of the US. Caveat there on a couple of high quality tech names in the US, obviously. But Asia ETF, we continue to hold this and are attracted to the value side of it there. On the biotech side, we've been buyers of this on the recent pullback here at around $58. The inverse ETS I covered at the beginning of the session, OZR, which is that resource ETF I mentioned. So it is under buy conditions here from mid-June at around $13. But again, our preference is predominantly just to stick with BHP and Fortescue. But we have reduced our exposure there, and we've been building a small amount in Oz Minerals. The banks ETF, so this is the global banks ETF again. It's on the list. It's worth sticking this into your watch list and keeping an eye on this. But buying it tomorrow is not the strategy, given that the price is below the average, and we have this picture which we're wanting to keep a closer eye on as a backdrop, which is the S&P 500 or the Nasdaq. Both the patterns look similar, but as long as the market's closing below this average and we have these overhead resistance in place at the moment, to us it's more about looking for defensive names, and we just take Cleanaway as example. That should be shifting up towards the top of your watch list. But even still, even though that's an area that we think is defensive and could slightly surprise to the upside, you don't want to be too aggressive on the buy side until we see that price action back above that moving average. And I'll continue to draw your attention to these patterns, both in those